Welcome back to The Explainer. So today we're unpacking what is arguably one of the most fascinating and definitely high-stakes concepts in the entire financial world. We're talking about Forex leverage. I mean, the foreign exchange market sees over $7 trillion traded daily, right? But how do everyday retail traders actually participate in that massive volume? Well, the answer is leverage. It's a tool of just incredible power. But, as our title implies, it is absolutely a double-edged sword. Let's get into it.
Okay, let's dive into this. How exactly do you control $100,000 in the currency market when you only have, say, $1,000 sitting in your account? I know, it sounds like magic, or honestly, maybe even a scam, but it's actually a standard, heavily regulated financial mechanism that's used globally literally every single day.
So here's the reality. Leverage is, at its core, simply a mathematical exposure amplifier. It allows you to control a really large notional position with just a tiny initial deposit. Kind of think of it like a volume knob for your market exposure. If you crank that dial all the way up to a 100 to 1, every single dollar you deposit is suddenly controlling $100 in the live market. But listen closely here, because this is vital. Leverage is absolutely not a gift of free cash from your broker. No way. You are not being handed money to keep. You're just temporarily borrowing exposure. You're not borrowing ownership.
All right, here's our quick roadmap for this explainer. First up, we'll cover the mechanics of leverage. Then, margin as your security deposit. Third, that double-edged sword. Fourth, what happens when trades go horribly wrong. And finally, we'll look at the ultimate safety net. Section 1. The mechanics of leverage, powering the multiplier.
This is where the doors really unlock for retail traders. It lets you step into the shoes of those institutional giants and access exposure you couldn't possibly reach with just cash alone. Now, what's really interesting about this concept is we have to draw a hard line between two terms that get constantly confused. I'm talking about leverage and margin. People use them interchangeably all the time, but they're incredibly different. Leverage is the multiplier, right? It scales your exposure up. Margin, on the other hand, well, that's the collateral. It's the actual physical cash requirement you need sitting in your account just to open and hold that leverage trade. Bottom line, you simply cannot have leverage without margin.
Moving right along to Section 2. Margin, your security deposit, the cost of admission.
Let's slow down the pace for a second here, because really grasping margin is what's going to keep you alive in the markets. You should think of it purely as your security deposit. Just grounding this theory in absolute reality, if you look at how an active broker outlines their margin requirements, you'll notice how margin is expressed as a percentage rate. So, if a broker requires a 2% margin, mathematically, that translates to a 50 to 1 leverage ratio, meaning if you want to control a $100,000 trade, your mandatory security deposit, your margin, is $2,000. The broker literally locks this up just to ensure you can cover any potential losses.
And I want you to really focus on that number, 50. 50 to 1, because that is not just some random example I picked out of thin air. Here in the US, regulatory bodies like the CFTC, the Commodity Futures Trading Commission, they strictly cap leverage on major Forex pairs at exactly 50 to 1. And why do they do that? Well, because they know that anything higher just exponentially increases the danger for everyday retail traders. Regulators put this speed limit in place specifically to protect you from extreme wipeout risk.
Which brings us to Section 3. The double-edged sword, amplified profits, accelerated losses.
Up until now, leverage might be sounding like a pretty exciting way to make big money with a tiny account. But I want you to put yourself in the shoes of a trader for a second, and let's drop the excitement. Because the reality of amplified profits is completely mirrored by the grim, totally unforgiving reality of accelerated losses. Let's say you have a $1,000 account. If you trade with zero leverage, just 1 to 1, and the market drops 1% against you, well, you lose $10. It's a tiny scratch, right? But what if you cranked your leverage all the way up to 100 to 1 on that exact same 1% market drop? You lose $1,000. Your entire account is wiped out, just gone, in a single 1% move.
So the crucial point is this. Leverage absolutely does not increase your profit rate. It doesn't magically make you a smarter or more accurate trader. What it does is simply increase your position size. And that violently amplifies your sensitivity to normal, everyday market volatility. A minor little market ripple that wouldn't normally even phase you, with a highly leveraged account, that ripple becomes a devastating tidal wave.
All right, Section 4. When trades go wrong, the anatomy of a disaster.
Let's examine the literal nightmare scenario that every single trader fears. It is so critical you understand how this cascade actually happens.
So let's walk step by step through a catastrophic account liquidation. Let's make these abstract financial terms feel incredibly urgent and real. Step 1. The market drops rapidly, moving hard against your highly leveraged position. Step 2. Your losses start eating through your available funds. And boom, your broker issues a margin call. That's a frantic warning that you have to deposit more funds, like immediately. Step 3. The market just keeps dropping. Your equity falls below the mandatory safety threshold and a stop-out is triggered. At this point, the broker's automated systems just step in and ruthlessly close your positions at a loss just to stop the bleeding.
Now let me tell you a terrifying real-world story to show you what happens when those automated systems actually fail. Back in January 2015, the Swiss National Bank completely unexpectedly removed its currency peg to the euro. This was a classic, massive, black swan event. Within minutes, the market moved so violently that prices simply gapped right past traders' traditional stop-loss orders. Those automated closeout systems, they failed entirely because there was zero liquidity. 24 hours later, retail traders who genuinely thought they were only risking their initial deposit woke up owing their brokers massive sums of money. I'm talking actual, legally binding debt. It was a bloodbath.
Moving to Section 5, the ultimate safety net, protecting your future.
Obviously, after that 2015 disaster, the entire industry had to change. Modern regulators stepped in hard to ensure that a 2015-style wipeout would never ruin retail traders like that again. And the solution they came up with is called negative balance protection, or NBP. This is the modern gold standard for retail safety. Essentially, negative balance protection is a rock-solid broker guarantee that your account balance cannot legally drop below zero. If some massive market gap causes your leverage losses to suddenly exceed your account balance, the broker steps in, eats that excess loss, and resets your balance to zero. So yes, you will lose your deposited funds, but you cannot fall into broker debt. Phew.
And this brilliantly illustrates exactly how seriously this is taken today. Looking at the official documentation from ESMA, that's the European Securities and Markets Authority, it proves that global regulators are actively enforcing these safety nets. They mandate really strict margin closeout rules and strictly enforce negative balance protection for retail clients across the board. The tail risk of those extreme catastrophic market events has effectively been shifted away from you, the trader, and onto the broker.
But listen, negative balance protection is just an airbag for a high-speed crash. You still need to wear your seatbelts every single day to survive the market. Before NVP ever has to kick in, you must be actively protecting yourself. That means always using stop losses to cap your risk. It means calculating your exact position sizes based on your actual account equity, not just maxing out the leverage they offer you. You have to monitor your available margin constantly. And above all else, never ever over-leverage a small account just because you're chasing quick profits. It's a trap.
I want to leave you with what is basically a universal law of leverage, drawn directly from the professionals. I want you to listen carefully to this. Profit comes from edge. Survival comes from risk control. Growth comes from discipline. Collapse comes from leverage misuse.
Which leads us right to our final thought for the explainer. We've seen today that leverage is an incredibly powerful, mathematically pure exposure amplifier. Right? It can turn a small deposit into a massive market footprint. But ultimately, the market absolutely does not care about your leverage, it only tests your risk management. So I'm going to leave you with this question to ponder. Leverage can multiply your exposure, but can your strategy survive the math? Thanks so much for joining me on this explainer. Keep your risk strictly controlled and keep learning. Catch you next time.